Hello everyone, welcome back to our series on financial literacy. Today we are diving into mutual funds and clearing up some of the confusion surrounding SIPs, equity and other financial jargon. Let's make investing simple and smart. So part 1 will be understanding the basics. You might have heard the slogan, mutual funds sahi hai. But what makes mutual funds the right choice? Let's start with the basics. Equity stocks mean you buy shares directly in a company, making you a part owner. Your returns depend on the company's performance. On the other hand, equity mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, reducing the risk and yes, managed by professionals. Debt mutual funds are those when you invest in fixed income securities like government bonds and corporate bonds. They are generally less risky than equity funds and provide more stable returns. Then what are balanced mutual funds or hybrid funds? These invest in a mix of equity and debt investments, aiming to provide growth with reduced risk. So this is what is the difference between stocks and mutual funds. We'll go on further to understand the different modes of investments in the next series. Let's get financially smart.